Hello, everybody. Kirk Spano, Retirement Income Options, December 4th, 2023. A little bit of house cleaning to get started. Over at both Margin of Safety and at Fundamental Trends, you will see shooters, Elliott Wave, and Technical Analysis Primers. Decided to make that the graphic. And if you click on it, here is shooters primary wave setups, a user guide, just kind of a quick tutorial. He walks through everything, what everything means. I know that some people don't understand Elliott Wave, so we just want to get you to the point where not necessarily that you can go out and do it yourself, but that you can read it when somebody is showing it to you. And there are 5 good videos out there by somebody that both Shooter and I like. So you can go ahead and take a look at their 5 videos. Should take you about an hour and a half, 2 hours. This book on Elliott Wave. Elliott Wave's Made Simple. You can read this in a week. So go ahead and click that. We'll just get the Amazon link. There you go. Very easy. Harmonic Trading, if you are in for a big read. I don't know, 273 pages. I have not read the whole thing. I've skimmed it. Maybe shove it into an AI and get a summary. And then, of course, you want Getting Started with Technical Analysis, which is an older classic. It is a great book to build on. So you read this, and then you start taking the next steps to building upon your education. And then what I use a lot of, and I've shared this with Teresa, Wyckoff 2.0 is what this guy is calling it. It is Wyckoff, just distribution and accumulation patterns, and how you can read them using volume profiles. So when you take a look at my charts, we'll show you in a second, or I will show you in a second, those bars on the far left side are the volume interest, particular type of study that I use. And there's a lot of things that are similar. The one I'm using is fairly simple, gets the job done. It shows you where big globs of money come into a position or leave. And it shows you where the air gaps are, periods where low volume can move price. So I would encourage you to first read Getting Started in Technical Analysis, read the Elliott Wave Primer, and then read this. You should have enough to be a good position trader at that point. If you want to be a swing trader and a day trader, then go ahead and sign up for Rare over at Fundamental Trends. So if you want to be a trader. If not, Retirement Income Options is the same as Margin of Safety Investing over at Seeking Alpha. And then there are lighter versions depending on what your needs are. And if you're a younger investor, if you're just getting started, Global Trends ETF or Sustainable Growth Trends is the way to go. And I would tell you that right now, I have a special on Sustainable Growth Trends. The first year price for Global Trends ETF is $199. Well, for an extra 50 cents, you can get all the stock picks too on the growth side. So Sustainable Growth Trends at $199.50 right now through a day or two into January, whenever I feel to take this down and get the affiliate program running. And then you'll only be able to get these 50% discounts through them. So if you are looking for my stock growth picks, as well as all the ETFs, because the Sustainable Growth Trends does include Global Trends ETF, then go ahead and join us today. Use code GROW, and for only $199.50, let's see, it might even work for me. Does it work? Yay! $199.50 for 366 days because it's leap year next year. All right, so over at Investing 2020 has been getting the webinars updated and the macro dashes. For whatever reason, we have to keep going in here and resorting it. No idea why I have to keep doing that. It's time to back up the truck on clean energy stocks. So that is our topic today, is what options should we be selling to help us back up the truck on clean energy stocks? Well, if you are reading along, then you know that I use TradingView. I use OptionStrat for building these trades. So we're going to walk through these today a little bit with the relevant securities so that you can see how to use these. And then they still have holiday sales going on. So go ahead and click on one of these articles and you will be able to get a discount. I'm also going to update the toolbox of useful sites to include those. So go ahead and take a look at the retirement income options, expiration update of November 2023 to get the links. And maybe by tonight, this will have been updated. All right, screening with TradingView. Now, when you pick out your list that you're going to screen, the orange tags are all the ETFs that I follow. You will want to go to oscillators, because these are basically the movements within movements that are being measured. So all of these oscillators measure change in real time, and that's what you want. You want to know if change is accelerating or decelerating, how steep the curves are, and then ultimately generate a signal. The combined signal here, they have oscillator rating, is usually pretty good. So if it says neutral, you have to figure it out yourself. If it says sell, you probably don't want to buy quite yet. Even though some of these look cheap, the downward momentum is still very strong. So you don't want to buy into anything with strong downward momentum. That's important. The whole try not to try to catch a falling knife. Let the knife hit the ground. Now, sometimes the knife falls on a stair and then it falls off again. Such is life. You'll have to learn how to deal with that. But if it says sell, that means the momentum is still pretty strong to the downside and you don't want it. If it says neutral, you have to figure out if it's cheap. If it says buy, then you should be really paying attention, because that means that it's just starting to rebound. And if it's cheap to boot, you're probably in pretty good shape. So this is the weekly chart. It measures every Friday how things have gone over the prior weeks. PBW marked at neutral, and I think it's very cheap. Invesco Solar rated as a buy. I think it's very cheap, just turning up. iClean, Global Clean Energy, and this was a favorite of the younger generation a couple years ago. So I'm curious to see if they pile into this one again. And then Q Clean should be here. There you go, neutral for Q Clean, and this is the large cap clean energy. So this is more global, this is more large cap, this is more all cap, and then this is of course solar. So let's take a look at some of these charts. Just right click and I'll let you open up the chart. We're actually going to start with Q Clean because it's the large caps. And this is the one that is very tied to companies like Tesla, SolarEdge, First Solar, your large cap companies. If you take a look, peaked in the middle 80s, and it just bounced off of 32-ish. Now, can it come down a little bit? Yeah, but ultimately I think we're about to start an uptrend sometime in the next year or so, but it could be a month from now, could be in the next couple of weeks. Right now, the market is a bit jitterbuggy. Mainly the large caps are having a hard time today. The S&P 500 is down about a percentage point, QQQ a little bit more than that as I speak. But small caps and Bitcoin are up. What have I been pounding on for a year now? Small caps and Bitcoin. I think that you're going to see a lot of choppiness in the large caps, even though I do think we'll hit 5,000 next year for maybe a 10-12% gain. But that's going to be because certain large caps do well and other large caps don't do so well. I think that the small and mid caps stand to have 20 and 30% years. Mid caps probably do the best, followed by small caps. But your biggest winners will be in the small caps. It's just that there's 2,000 stocks out there between micro caps and small caps. You have to pick your spots. Indexes don't do the job. Now, over on the clean energy side, your large cap index has come down. It looks like it's about to take off. It hit right at the bottom fishing that I had set up. I mean, that's pretty interesting, right? So here we have the bottom fishing that I set up, largely based on these volume profiles that I mentioned a second ago. Right in here, big interest to push the price up, and then you start losing interest right in here. And of course, it did actually fall right off that cliff. So where the interest dried up, it dropped in price to the point where down here, there's so little interest that there's really nowhere for price to go down any further. There's no sellers left. So this looked like a pretty reasonable spot for the price to bottom out. And of course, you do have some pretty big support in here, at least higher support here than there was here. Ultimately, you're looking for another high interest rally. It'll take some time. But once it starts getting to this point up here, where it's above this resistance zone, so it's gonna get up to here, it's gonna be challenged, and when it finally gets through, it should take off. And I think this is one of the sectors that will actually set new highs, especially if Tesla does well. If Tesla leads, this will set all-time highs 2, 3, 4 years out. Right now is the time to accumulate, sell cash secured puts. If you are bullish on Tesla in particular, this is the fund you want. I think Tesla is range bound between $500 billion and $1 trillion. Now, that's all right because it's closer to the bottom than the top right now. But this is an ETF that I would probably trade a bit, not like every week or every month, but with the anticipation that on the next big rally, as Tesla, who we can overlay a correlation, peaks, the next time it peaks, orange being Tesla, the next time Tesla gets up here, it'll pull this up. You can see that it hasn't helped all that much this year so far. But as Tesla rises, this will rise. When Tesla gets in this area, which is close to $1 trillion in market cap, that means that a major component, about 10% of the portfolio, because Tesla makes up about 10% of this portfolio, basically doesn't have any growth left in it. Unless you think Tesla's going to 2 trillion. I don't, but I could be wrong. So this is the fund to use if you're very bullish on Tesla and several of the other large caps like Sedge, like First Solar, like Enphase. A more all-cap approach, PBW, and this too has gotten crushed. Now you can see the time frame I'm using. Basically, from the end of 2018 when we had that last crash to looking about a year out. And I think you should be thinking about clean energy more in lines of 3, 4, 5 years out, but everything you get bombarded with is based on the next year. So I kind of acquiesce to that. But I will tell you, the next year is always just whether or not I'm selling or buying. And then I'm looking for that ride up. This is a heck of a correction. At a time when, as we covered on Saturday, a lot of these companies are becoming profitable and growth rates are still high and likely to accelerate for a while and stay high well into the 2030s. We need about 10 times more clean energy than we have. That includes everything that was built in the past up to this year. That's going to take a little while to build. Now, somebody said that we need 100 times more clean energy, and maybe he's right. That was a executive with a European or Middle Eastern oil company. It was the largest private oil company in the Middle East. So that's who it was. Their CEO said we need 100 times more clean energy to replace fossil fuels over the next couple decades. So that's a big ramp up. This is, if you're an investor, the time to buy this industry. I like the all cap approach. That's what this one is, global all cap. About 60% American, I think, but the rest is international. And I think that you are in the jitterbug zone, so you can sell puts here, and you want to take positions along the way, basically buying your dips that are 5 and 10% dips after you have your starter, and keep selling options, because ultimately we get another rally. And I would think that over the next, again, into the middle of the decade, 26, 27-ish, 28-ish, you're going to see either new all-time highs or at least a challenge of these all-time highs. Very adoption curve oriented, right? You have your spike of enthusiasm followed by investors losing patience because we have to take time to adopt a technology. That's what's going on here. This is part of the whole hype cycle idea by Gartner. And eventually you're going to get a nice long slope of enlightenment, pace of adoption. And the millennials love this sector. Again, millennials love clean energy investments, and they are the biggest contributors to the market now. That is very important. So if you're a baby boomer and you're dismissing them, you can't. More of them are working than boomers. They're the ones driving investment now. They are the most important money in the market because they are the marginal money. And as we know, prices move at the margin. So while Exxon might be a wonderful company to you, it's probably not going to do anywhere near as well as these younger, leaner, faster growing, good balance sheet, becoming profitable, clean energy companies. Go over here. We'll take a look at the one that the millennials really ran up last time. So you can see this is old. And everybody who's been looking at my charts knows that this is a very old format. So way back here in 2021, when it was way up there, I said, these are your levels where it's going to come down. And look at that. It bottomed exactly 2 years later where I said it would bottom. I haven't touched this chart. You can go find it out there. So let's erase it. It's about time. Remove the drawings and figure out where do we think it's going. Well, we can use a fib retracement, and you go from the top over here to the bottom, and we know that a typical corrective rally, what's a corrective rally? A corrective rally is just, corrective always just means changing directions, would be to about this 0.618 line, give or take. So you're looking at iClean probably going from middle teens to middle 20s pretty easily. But the next 618 extension is way up here in the middle 40s, then middle 60s. I don't even have it listed. So you're looking at a potential, because this happens on big rallies. Every now and then you get a 3.618 or a 4.618. Those are rare. This one's pretty typical. I think that you're going to see iClean run into the 40s or 60s in the next few years. And I think that story is similar for all the other ones we looked at. I'm not sure what drove this one with the millennials. I'm not sure why this particular ETF caught their attention, but it did. Maybe because it's iShares. So if you want an international approach, iClean is definitely one that you can look at. These funds actually work well together. I designed it that way. So these 4 funds that we're looking at, PBW, QClean, iClean, and TAN, you can use all of them. And the reason you would use TAN is because half, a little bit more than half, we talked about this on Saturday, half of all new energy production is solar. Think that through. Half of all new energy production is solar. Everything else is the other half. So if you believe that this bottomed, and again, I set this line a while ago, I don't even know when. It was quite a while ago. You can scan the service and see the oldest chart where I have this bottom fishing around 40 bucks. I think this is going to rally in the next year. It's going to make a run at this area. See where it'll start running into some resistance here. I think it's going to run till around 70. It's 47 right now. So I'm showing you a bunch of ETFs that very well could be up 30 to 50% next year. And maybe, if we don't get a recession, which I don't think we're going to, maybe these double in a year or two. This could be a really good year coming up. I know a lot of people who have been talking about an imminent recession and the Fed causing a recession keep saying it. I think they'll keep being wrong. I think the American economy is that strong. I think labor is that tight. I don't think AI changes things quite that quickly. But at the margins, AI is going to make companies at least able to maintain their profitability in most cases. Certain companies aren't going to show growth, and they're going to have to pay down debt. So the AI is going to basically keep them in business. But the companies with lean balance sheets and high growth rates and AI helping with their technology, whether it's how they produce a material or how they do their services, how an end product widget is manufactured, is a big deal. It is the thing that offsets the idea that interest rates are normal-ish, right? Not a huge bull market and falling interest rates coming. We're going to get interest rates falling a bit, but it's not going to be a 30-year bull market. We're in the chop zone on interest rates. Yes, I think the Federal Funds Reserve rate, the Federal Funds rate, the Federal Reserve Funds rate next year will get down to around 3. I don't think it's going to be over 4 or 6 cuts. I think it's going to be over 2 or 3. It's going to be bam, bam, bam. I even think they might tell us the truth. Get that. Federal Reserve telling us the truth. I think the Federal Reserve is going to tell us, hey, we're doing this because we need the banks to be healthier and the economy is slowed down enough and inflation has fallen enough that this isn't going to cause inflation. So you're going to get a supportive Fed at some point, first half of next year. I think it'll be more shock and awe than a glide path. So I don't think the boogeyman is a potential recession as it is a bank collapse. Well, bank collapses are easy to fix. You just give them money and say buy treasuries with it, which is what we need since the Chinese aren't buying as many treasuries. Circle of life. All right, so how can we sell options here? Well, if you go to OptionStrat and you build yourself a cash secured put strategy, I already have TAN up. You take a look at the February's because April's a little too far out. You say, okay, TAN is at 47 right now. Let's take a look at a $45 put and see what that gets for us. $237 per put, about 5% for December, January, February. So for about 3 months. Annualized, it's around 20%, a little compounding, a little higher. would you be okay making 20% on your money market money over the next year? This is actually about the bottom of what I'm looking for. So if you want something that's out of the money and gives you some cushion, meaning that even though the price today is 47.75, you'd only get assigned this security at 45, which I think is pretty cheap. Still be collecting 237, essentially a 20% annualized return. What if you wanted to write it basically at the money? Now you get 370, an extra buck, an extra couple percent. I think for me, what I'd rather do is I'd rather sell the February 45 and then make sure I have at least a starter position in TAN. What about my all cap favorite PBW? So not a lot of volume on this one. It's hard to sell the puts. That's why the prices were backwards. You should always get more money for the longer duration puts. If you can't, then something's out of whack with the market. Very low open interest. So if we sell these puts, we're basically the open interest. We can try to make this market, which means that we pretty much have to do January. Market maker isn't going to make our life easy. So if we want to sell $27 or $28 puts, we're going to have to offer. I will describe in the article how to do this, and we'll see if we can create an option selling market here. See if we can generate some interest. Because I think if we ask for a little bit extra money, he'll make this market for us. That's how it works. So as a group, we can start to create an open interest profile and see how this goes. $500 million, kind of low volume. So maybe we can't. So if we go over to iClean, more money, more volume, probably better here. Might have to reassess whether we use PBW. I just love the structure, but it's not capturing the public attention. Yeah, much more robust option market on iClean. Again, it's because the millennials like this one. So if we take a look at the holdings, this is a lot more large cap too, very similar to QClean, but not emphasizing Tesla. So if you don't love Tesla, use iClean instead of QClean. The article that I'm putting out today will describe that. So let's take a look at TAN, because this one is, there you go. First Solar, Enphase, Solar Edge. That's a good basket of solar stocks. Sunrun. What I've been doing is I have some SunPower that I've been buying just lately. Then I have it alongside this fund. Why is SunPower held separately and not these? Because this is a good basket. SunPower is not in it. I augment my solar holdings with SunPower on top of this fund, TAN. So I think we're probably going to skip the PBW puts, or we're going to try to make a market. We'll see if you follow me in. I'll try to do it on my own, see what happens. You can follow me in if you like to. iClean, it's got a market. Probably have to do the January's. April's a little too far away. I think you can go a little bit in the money with the 15, get 80 cents. It's a little over 5%. Again, you have a annualized return well into the 20s. You can go a little out of the money at 14 and get less. Still pretty close to 20% annualized though, if you eyeball it. QClean. The way that I'm going to do it at Blue Mound is I already own PBW. I just sold TAN puts when I told you last week. I have a small TAN position. I have to have a deep think on what I think about Tesla. I know I don't trust and necessarily like the guy running it. I'm not sure if I want the lithium producers or Lucid, so I'm probably leaning towards iClean. It has a much more robust option market than QClean, but I think probably iClean is the one that you really want to sell puts on to complement the holding in PBW and whatever solar strategy you're going to decide to use. Now, as far as the individual stocks go, I think it's really hard to own the individual stocks, and not because they're bad, but they're hard to keep up with. So unless you are really going to put the time and effort into studying these companies and understand that they're volatile, I would just make your position trades in TAN, PBW, iClean, and depending on how you feel about Tesla, QClean. I think that those work together pretty well. Again, I'm a little ambivalent about Tesla right now. I just don't know if their business justifies the investors that are in that stock. And more importantly, I'm not so sure that Tesla is going to get new investors. I think the peak of people investing in Tesla has happened. I don't think there's really a lot of new people left to invest in Tesla, and that's going to be a problem for its share price going forward. And ultimately, I believe that GM, Ford, Volkswagen are all just as valuable as Tesla in the long run for different reasons. But I think that ultimately Tesla is range bound, and these super beat up car company stocks, I think they have a long way to go up. right, any option questions? Anybody that you want me to run through here? Remember, this is behind the $1.99 paywall now, because I don't want this out here in real time. So when you go to retirement to income options, for a week or two, it'll be behind the paywall. I'll probably each month when I do the expiration update, I'll go back and I'll make these available. Sun Power, sure. This is the one that actually I've had put to me, so I already own it. I'm not selling more puts, but if I were, I think I'd sell the January 5 and get almost 10%. So that's an annualized return, of around 40%. You could go a buck outside the money. I think there's a 4, yeah. Still do pretty well. But I think the solar stocks are all going up, so I think you can be right on top of it. Do the 5, get this big annualized return. If the stock gets put to you at 5 minus your premium, you're in it for 453. I think that's pretty good. Now, if you're in it for a net cost of around pushing 8, like I am, you can sell these puts to reduce your net cost basis. Either you've got premium or you end up with the stock averaging down by a lot, right? Remember what we've talked about with averaging down? You don't do it every 5 or 10%. You look for 30 and 50% price changes. Stocks that go from 20 to 7. Stocks that go from 30 to 5. You're looking for 20, 30, 40, 50% price declines before you scale in again. That's something that I really have to remind people of. Averaging down should only be done if you're really changing your average cost. You don't do it just to add more. Oh, look, I'm 5% cheaper. Who cares? 5%, big deal. That's one day move. That'd be one of the things that I would remind you of is average in at wide price points. So once you've got your initial starter position and you sell that first put for a little bit less, you're not really adding again until either the stock is moving up, in which case you build your pyramid position bigger, or if there's a big decline, fell off a stair. All right, I will get this up soon, and I still have one of the Saturday videos to get up, so I will do that next this afternoon. And then we have a couple of articles tonight, a couple articles tomorrow before I leave. And then I will be in New Orleans until Monday, and then Houston on Tuesday. Actually, Monday I'll be splitting time between New Orleans and Houston. So we will do webinars on Saturday, but not Monday. Monday I'll be in the air, I think, at that time. So no retirement income options next week, but we will do the Saturday call live, maybe from Bourbon Street. We'll see. Probably do it from Harrah's Casino in New Orleans. All right, have a great week, and we'll let you go.